Today, we have Pedro, Neira, and Alejandro Muñoz, who are members of our community, but also have a lot of expertise guiding some founders in the process of fundraising. So thanks a lot for joining, Pedro, Alejandro. Thanks a lot for sharing your time with the community, not only members of Landa, but also external, probably some founders that want to have some tips on how they can structure this process. So I don't know, Pedro, Alejandro, you want to introduce yourself to the community? We have some members and some people that already are joining, but I will let some people in the room as they come. So if you are okay, we can start with this little introduction. I don't know, Pedro, if you want to start.
Thank you, Neira. I think it's going to be an awesome session with Alejandro. So to introduce myself, I'm a serial entrepreneur. This is what I've been doing for the last 18 years of my career since I finished my MBA. Why am I sitting here? Probably because I pitched around 700 times to venture capitalists over the course of my career. I put some numbers just to share with you guys some of these. I pitched around 700, 800 times. I think I had 120 different versions of the decks that I've had from the 4 startups that I've led as a CEO over the course of my career. I closed 95 investors, which gives me a kind of a closing rate of close to 14%, which is normal. It's nothing extraordinary. But just to give you a sense, I raised around $17 million in adding up all the money that in all the 4 startups that I've worked in. And I've raised money from United States, Silicon Valley, Los Angeles, New York, Spain, Japan, South Korea, Mexico, Costa Rica, Brazil, Peru, Chile, and Argentina. So I'm happy to share a little bit of what I've learned over this long period as an entrepreneur fundraising. And I specifically have more experience in the early stages, pre-seed, seed, up to Series A. I haven't had the experience raising Series B or Series C, so we're going to focus the talk on this stage of the fundraising path. I think that's on my end. Alejandro, please, your turn to introduce yourself.
No, thank you, Pedro. And I know it's going to be a pleasure, spending the next hour with you and with everyone online here. And thank you to Lana Club for putting this together. A little bit about my background. I'm originally from Mexico, so de Mexico. A lot of my background, I has been in mostly 2 verticals. I spent a lot of my career in fintech and in supply chain and logistics as an operator, then as a CFO, and that's where I've had the experience of managing and also raising capital, and also as an investor. So as an investor, I'm actually in the process of raising my own venture fund. So we're raising about $30 million. It's a very different process than raising capital for a startup. But there's some correlations there. In the startup space, raised about $70 million to scale a couple of ventures from anywhere from pre-seed up to Series B. And I can totally relate with Pedro in terms of how long the process is and how many versions of different decks and how many conversations, and maybe a good place where I always like to start is that, and I'm glad that everyone is here. But we're in an industry of no in many cases, right? It's about hearing many no's 90% of the time, and as an investor saying no 90% of the time as well, right? So now that I'm an investor as well, I can empathize quite a bit with everyone here on the call. So really excited, to be spending the next hour with everyone here.
Awesome. Thanks a lot, Alejandro, Pedro. I see that some new people joined, so probably this is a good time to share a little bit about the agenda. So as you already know, this is like a casual session when you have the opportunity to ask specific questions to Pedro, to Alejandro about the fundraising process. If you need any tip, you have a specific situation right now that you need a solution, a tip, or something to unblock a challenge that you already have. This is a good time. So I encourage you, not only the members, but people in general that maybe this is the first time joining and being in an event or in a session with this kind of format. So you can unmute yourself. You can put your questions on the chat. We already have some questions prepared, but probably the best way to take the best of this time is if you have a specific question, you can raise your hand or unmute your mic and you can share the question with the rest. So I don't know if we have any volunteers or anyone that has these questions in mind already. This is a good time to probably to start.
And maybe as questions come in, maybe, if we can potentially do like a show of hands of how many of you are founders, like what are you trying to get out of this conversation? Like, are you in the pre-seed stage, seed stage? Like, maybe share a little bit about that if you're actively raising and at what stage. I think that would be super helpful.
Awesome. I think we have a small survey, so let me check if I can put it here. I don't know if you see the survey on your screen. Awesome. Yes, that's maybe a good time to share this. Yeah, okay. Some of the members or the people attending the session are founders. We have 3 founders, 1 operator. Probably you have more than one hat, for sure. Probably you're a founder, investor, a mentor, different profiles. But if you in this session need to select one, probably that's also one option. It's okay for this moment. We have 5 founders, 1 investor, 1 operator. Well, we have some founders here, so probably, yes, Alejandro, if some people want to share this stage, probably they can write that in the chat.
Super. So I guess maybe where we can start, maybe, might be for those of you that are founders, and you're probably here because you're trying to raise, probably at the pre-seed, at the seed level. But maybe a good place to start is, when going through a pre-seed or a seed raise, I typically like to start off by figuring out, first of all, how much money do I want, right? How much money do I need? And for that, I try to take into consideration 3 things. And then maybe we can expand on this, Pedro, and I would love to get your thoughts. But I would typically, like to start with 3 things. One is, at what stage am I, right? So my pre-seed and my seed, what do I want to test and prove out with this, these next 12, 18, 24 months for my company, and from who do I want to get money from, right? Because I think those 3 things, that are tied to how much money do I need to raise, change the conversation quite a bit in terms of how do you approach the fundraising process, right? Whether you're thinking of angels, whether you're thinking of maybe family and friends, VC money, and if you're ready. But Pedro, I don't know if you have any initial thoughts on what I said.
Yeah, I think the most common question that I hear when founders tell me they're raising in the pre-seed stage is, I don't have any revenue, I don't have any customers, so I can't raise. No, and that's 100% false. You can raise. You can raise with an idea. You can raise with a PowerPoint. You can raise with a mock-up, with an MVP. That's exactly what pre-seed stage is. So yes, you can. Are fans gonna give money to anyone with a PowerPoint? No, not at all. Probably they're gonna give money to the right founders, for the founders that are a good fit for that idea. So let's imagine if you have been working, I don't know, 25 years in NASA building rockets, and you leave NASA and you want to launch a new company, and you partner with a good co-founder, and you have just a PowerPoint, and you go raise with that, yes, you're going to raise money. You're going to raise money. But if you're a, I don't know, college graduate that wants to build the same rocket company, and you have a PowerPoint, probably not. Probably you're not going to raise money. So at that stage, what you need is a compelling idea, and I would say 80% of raising money at pre-seed stage is the team. The team has to be strong enough to convince other investors that they can execute on that particular market or that particular idea. Later, the criteria changes, but at pre-seed stage, I would say that's the main driver. And guys, please feel free to either send your questions to Yanira in written or unmute yourself. I don't know, Yanira, however you want to manage the questions. But
I have one question here from Andrea, who is founder of Black Cube Labs. I don't know, Andrea, if you want to unmute yourself and share the question that you already shared on the chat. So probably you will be able to explain a little bit more about the situation that you're asking.
Sure, thank you so much for the chance. Hi, Alejandro and Pedro. I'm the founder of Black Cube Labs, which has the ambition to become an ecosystem of generative AI solutions. But in particular, there is one project we're focusing on. It's a new generative art platform. I'm working with a co-founder, which is a serial entrepreneur from LA, with technical experience. So he's my CPTO. And we are at the stage where we are trying to figure out how to build our POC. So we aim to raise, but only after we have a proof of concept with around 30 to 50 alpha paying users. And so my question is, how do we approach the fundraising process with angels and VCs in North America, mainly US and Mexico?
Sure. I mean, and thank you and congratulations on what you're building. And it sounds really exciting. When I think, especially right now at the pre-seed stage, and if you're thinking, because here you mentioned, you're trying to approach both angels and VCs. I mean, I would first start thinking about, and I'm not going into, how much money you're raising, but I would start thinking about what are the motivations for these people, right? So because angels and VC firms are very different, right? So, and even family offices in this case, right? So when you're thinking of angels, you're basically reaching out to folks that understand the space for the most part, well, ideally, folks that can clearly see the value of building what you're building, right? So I would think of the angels as evangelists, folks that can that really believe, that understand the space. They're industry experts, and they give you some sort of, because it's not just money for money's sake, but they also give you some sort of good marketing in a way, right? So having angels that understand the industry it's a signaling kind of a thing, right? So I would really target the angel community in terms of how close they are to your product or your industry. And when it comes to VC funds, I mean, and I would stage it as well, right? I would start off with the angels and of course start having conversations with VCs. But with VCs, so far my experience has been pitch them without pitching them. Like if you need the money right now from the VCs, you might be a little too late, right? The idea is to start building a relationship with these firms, so that you can update them, right? Tell them, hey, I'm not raising right now. This is what we're doing. We have these angel investors potential. I'm talking to these people. These are the people that I'm adding to my advisory board. And when you're ready to raise, you've built a relationship with them, then they're more willing to take a deeper look. But happy to go deeper there. But Pedro would love to get your perspective.
Yeah, I want to ask you, Andrea, why do you want to wait until you have 50 paying customers to raise? What is the rationale behind that number?
We believe two things. First, we can raise more if we can show traction rather than just an idea. We have to raise more because what we're building is going to cost us GPU cloud and all sort of things. And also, second reason is we are still trying to figure out technical feasibility. So before going out and say, hey, we're building this, we actually need to know if we will be able to pull this out. And it's a super far-fetched advanced technology. So there are not many experts out there that are easy to find to help us. We're actually running interviews with like 15, 20 experts from all around the world to figure out who can partner with us to build this.
Okay, I would challenge that path. I'm not saying mine is right. I'm just challenging, saying, first of all, there is money, there is people and money to actually test what you just mentioned. So there's people willing to invest. If you want to test, if you can technically build what you're saying you're going to build. So there's money at that stage. And there's people willing to invest at that stage, which is before you can even prove that that is feasible to build. Okay. So if you can raise and you say, investor, VC or angel, I have this idea. I don't know if this is going to work, but I want your money to test if this is going to work. There's a lot of money willing to invest at that stage. Okay, so that's one thing. And the other thing is, you mentioned you believe that you need 50 alpha paying customers, and with that you're gonna be able to raise more money. I would say validate that. Don't just believe, because it might be 10 paying customers. It might be 5. Maybe you don't need 50, or maybe you need 100. But that number, and how do you validate that? You ask if you ask a VC, for example, you ask a seed stage VC, what do you need to invest in me? He's gonna say, as you are pre-seed, he's gonna say, no, you're too early. Okay, I know I'm too early. What do you need for me to not be too early? He's gonna say, okay, I need you to head to $1,000 in recurring revenue a month. I need you to sign 3 B2B customers. I need you to, I don't know, whatever. That is enough. If you see that number or that answer being repeated, that's how you validate that 50 or 5 or whatever, because it might not be true and you're focusing on a wrong path. You're trying to get to 50 paying customers. Maybe that's not what they want. Maybe they want 3, or maybe they want something else that is not alpha paying customers. I'm just trying to challenge that path, so you give it a second thought.
Thank you so much.
Welcome.
Yeah, and then I mean, I would say, especially, I mean, right now that you're, I mean, from what it seems, that AI space, I mean, there's a lot in your favor that I'm sure that they'll definitely listen, right? So even some traction, I think, is good already for them, right? I mean, if the technology is differentiated, I mean, I'm sure that especially the VCs, they're getting a lot of inbounds from AI startups, but you'll catch their attention for sure if you have already some customers.
You know, also what's stopping me? It's the fact that this is a painful exercise that lasts 3, 4, 5 months of work. Endless meetings, finding those guys, talking with those guys. And so I wonder, is right now the right time to do this, or should I just focus on building a little bit the product at least, so that I have something that I can share with them?
I mean, typically and maybe this is just off the bat, and then Pedro, I would love to also get your thoughts. But I mean, when I think of fundraising, is you're buying time, right? So fundraising is buying time to be able to prove, to get to be able to de-risk whatever you're building, right? And build a business. if you can, I mean, and this, I'm putting my operator, founder hat on. For me, I'd rather bootstrap as much as possible so I can give up as less equity as possible, right? And delay that fundraise as much as I can, right? I mean, right now, for example, there was a question here related to, is 10% equity, a good, an acceptable, dilution for a pre-seed round. I mean, that depends also on the size, right? So I would be thinking, Andrea, like, first of all, how long can you operate without having to raise? And then if you raise, how much money do you need for the next 2 years? Because ideally you should be, that's something that we have seen over the last 2-3 years is, the fundraising timeline has expanded, but also the time in between series has expanded as well. It used to be like 18 months. Now it's 24 months, what the capital should last you. So Pedro, I don't know if you want to add anything there.
Yeah, to answer, another way to answer your question, Andrea, following what Alejandro said, is that anytime you fundraise, it's going to divert your time from the business, from actually building something. So to answer your question is, one way to answer the question is, can you build whatever you want to build with your actual resources? Yes or no? If the answer is yes, you can delay and you can build and fundraise later. But if the answer is no, for example, if you need 5 engineers and you're just 2 people, and you cannot build whatever you need to build without those 5 engineers, you don't have a choice. You have to fundraise now, because otherwise you can't build whatever you're trying to build. The thing is, you should try to build as little as possible, as minimum as possible, even like a mock-up. And for a mock-up, you don't even need a CTO for a mock-up. You can do it in Figma or PowerPoint or whatever. Because that's what you want to de-risk. What that is the idea, something that people want to see in the market. Can you technically build something? So build as little as possible. And for that milestone, do you have the resources or not? If you don't have them, you have to fundraise now. If you have them, you can delay. And probably, as Alejandro said, you should delay and bootstrap as long as you can and raise later.
Thank you so much, both of you.
Awesome. In the chat, Jose Francisco Timarchi, who is also a member of the community, asked about the percentage, but I don't know, maybe Alejandro or Pedro. It was like a 2-part question. The first one is, what would be an acceptable equity percentage for a pre-seed round? I don't know if you have any comment. And then he had this 10% example, but I don't know if you have any comment about what is an acceptable percentage.
I think there are there's a lot of documentation about how the dilution looks for each round. It's around 10, 15%. It's around there. But it varies according to industry. There are some industries that are more capital intensive. So if you want to build something like in hardware AI, there's a lot of capital there, and you're going to dilute much more than 10, 15%. If you're building something with whatever CapEx or hardware component, it's not going to be 10%. It's going to be more. If it's 100% software-based and code-based, it's usually around that. Between 10 on the low end, up to 20%, I would say, in the higher end.
Yeah, and I would echo that. I mean, what I see, especially in software, I mean, and thinking about the size, I mean, if you're raising less than $500,000, it's probably like 5 to 7%. But if it's a round of 500 to $1 million or more, then yeah, the percentages would probably go up to like between 10 and 20%. And I think, the best way to think about it is try to reverse engineer it, right? And this is why I was during my initial comments, thinking about the motivation for the investor, right? At the end of the day, for a VC investor, right? They're looking, they're investing in you because they think that they'll return their fund with your investment. At least that's the approach, right? So if their fund is X size and they need to return 2 or 3 times that amount, right? What do they believe the valuation of your company will be, and how much of it will they own at the end? So try to reverse engineer it a little bit to try to figure out how they're going to try to negotiate that initial dilution and ownership. So it seems very mathematical, but
Yes.
seriously, that's how VC firms do it.
Pedro, nice to meet you. I made that question on behalf of a Nutritech startup I am currently advising right now. And another question derived from that is, how can you get a framework to allocate that money? Because I understand that when you do a seed round like this, it's not always going to go to the OPEX, for example. How do you make a division and between the operational expenses and those huge bets that you have to do in order to keep growing? How would you tackle that?
So in pre-seed, it's actually very easy. I mean, in pre-seed, you have a lot of risks. You don't have a business model. You don't have a product, probably. You don't even have a product. So all your job at the pre-seed or seed stage is to de-risk your startup, okay? To take away the risk. So for example, you have a product risk, which means you don't know what your product actually has to do or how it's gonna look. So probably usually one of the first milestones of a startup is to get product market fit. So you should allocate all the resources on finding product market fit, all of them. There's nothing else, because if you don't find product market fit, nothing else after that matters. Not even your marketing plan, or even the other. I mean, that's the most. I mean, but in other cases, you change your market. For example, product market fit. It's not only on the product, but also on who are you selling to. Maybe you don't know. You thought initially your product was gonna be aimed to designers, and you end up selling to, I don't know, to realtors, something like that. I mean, because this happens quite a lot. So my simple answer would be, you allocate 100% of that money to get to the next milestone that de-risks your startup, and that's it. I would say nothing else.
Yes, and as you said, probably the most straightforward point to that is finding product market fit, right?
Yeah, I mean, but to go back to your question, for example, if you need to find product market fit, maybe you need to hire a couple of engineers, maybe you need to hire a product guy or something like that, or a sales guy or something. So yes, you need to hire some people that will take you there, to take you to that point.
So clear, thank you.
Christian, you raise your hand. You can unmute yourself if you want.
Okay, thanks. I'm Pedro. Hi, and thanks for your time. My question is, do you believe that founders that don't have a clear path to 100 million ARR, should fundraise, having in mind that LATAM is not as liquid as other markets?
You can fundraise, try to fundraise, but usually VCs are not going to give you any money. I mean, as Alejandro mentioned, all the investments of a VC, 100% of them, are made with the belief that they can return the whole fund. So it's not that a VC invests, okay, this is going to give me a 1x return. This other investment might give me a 2x. I'm going to earn 50% here. No, all of the investments of a VC fund are made with the belief that they could return 10, 50, or 20x. They know that most of the cases that's not going to happen. But when they invest, they have the belief that there's a significant chance that this can happen. If they don't believe that, they don't invest. So
can I re-ask?
Yeah.
So I'm asking this because I've been asking myself if it's like to choose this path or not? Because, for example, imagine that a founder raises a pre-seed, and then before getting to the next milestone and achieving the necessary milestone to raise the seed fund, they see that the market is not big enough, and that they prefer to, just change the path to a sustainable business instead of trying to reach like the next milestone and the next one and the next one until they have a liquidity scenario. So
that's perfectly fine, and that happens a lot. That happens quite a lot. But the only thing is that VCs are not going to fund that company. That's fine. There's no problem with that. I mean, you can. There's a lot of other ways to fund your company that are not VCs. Actually, VCs, I mean, probably wouldn't be the first choice for a lot of businesses. So if something like that happens along the way, either at the beginning or at the middle or at the end of your business, that's perfectly fine. You found a business, you found a good business, that's great. But VCs are not going to give you any more money. That's the only thing. You can raise money from banks or other investors or angels or other kind of funds, but not from VCs. That's the only thing you need to know.
And sorry, my last question on top of that is, then is there any conflict of interests between the VC and the founders when they end up in that situation, like in the middle, for example, after raising a pre-seed or a seed fund? Like how is that a scenario? Because I have only imagined that, but never listened about it, like actually of someone that has changed his mind or their mind to opt for a sustainable business instead of raising the next fund.
I mean, what I have seen, and I haven't seen that scenario specifically, but of companies that are no longer going to be able to return that X amount, like VCs will. I think that communication is the most important thing, like the continued communication, so that they can. Because I don't know if it's because of a decision or just you identify that the business is no longer going to be that, right? If it's the latter, right, that you realize that the business is not going to be that big success, that's why it's so important to keep good communication throughout, because the way in which the business, you could say, fails to achieve that outcome, it matters, right? And I think investors, then what they would try to do is either try to sell back equity or sell it to other folks so they can do some sort of partial exit. And I can imagine many things, like maybe they'll just, as Pedro mentioned, they won't invest any more money, but they'll try to, divest in some way, shape, or form. But I think the communication is a more important thing, that both parties come to the same conclusion. And who knows, maybe they're able to sell, to some other type of fund that is able to continue, the rest of the life of the business with you. But Pedro, I don't know if you have any thoughts there.
No, I agree 100%. If you tried, I mean, honestly, and didn't succeed, and ended up with a sustainable business, and you were transparent all the way, as Alejandro said, the businesses are going to understand that happens. I mean, another thing is that you knew all the way that you were going to build a sustainable business, and it raised from VCs. That's not the ethical. That's not what you should do, because you knew from the beginning, before raising, that's what you wanted to build. That's where you end up in a bad situation. But if you communicate it transparently all the way, and you end up in that scenario, there's not a problem. I mean, that happens quite often. More, I would say that happens more in Latam than in the US, probably.
Thanks a lot.
Thanks to you, Christian. We have another question in the chat from Juan David Bolivar. I don't know, Juan David, if you want to unmute yourself and share your question.
For sure. Thank you, Neira. Okay, so let me explain first my case. So I am the founder of Kaleido. So in Kaleido, we create safe spaces for LGBT people. we basically connect people who want to make an event such as yoga or trekking with participants that wants to go to that event. We started with this idea like 5 months ago. It's quite new, and I think we are having, or I have, I think we're having some market fit in general. We're finding it. I've seen that there is a lot of demand of this kind of activities, but currently the business is going so far. I've been bootstrapping it, so everything is funded by myself. And lately, I've been thinking that maybe it would be great to have some. I mean, to start fundraising. Still, it's just an idea that I'm starting to think, but I am not completely sure if I should fundraise or keep just bootstrapping. But anyway, if I want to start fundraising, then what kind of tips can you give to us in order to like start this process? Because this is something that in my case I have never done it before. So this is my case. Thank you.
Hey, Juan David, and if you wanna, I'll kick it off a little bit, but it seems like you're very early on in the process. I mean, you found an idea, and what you're doing, it seems that, you know, you're having some following. I would start off with, I mean, even before angels, like even foundations or nonprofits that might have alignment with what you're doing, to figure out, you know, because maybe they have a lot of experience in the operations side, on the marketing side, trying to find some sort of partnership. That's where I would start initially, so that you can learn more, right? Get more data, understand the scalability of what you're doing. And then from there, I mean, if you see that this is something that you can continue to build, then I would follow on to angel investors, people that are aligned with your mission, right? People that care about what you're doing, and that could be leaders in the LGBTQIA space. That's just, you know, without me having the full understanding of the business, but how I would think about approaching it, you know, at such an early stage of your business and your venture.
Yeah, where I would start to add on top of what Alejandro mentioned is, you should ask yourself the idea, why do you want to fundraise? Okay, because the ideal world, you shouldn't fundraise. If your business is good and you're selling to your customers, you don't need any money. That's the best scenario. That rarely happens, but if you are in that spot, you shouldn't fundraise at all. You have 100% of your equity, you grow, and you grow with the money from your customers, which is the ideal world, not from the money from investors. Okay, if you want to fundraise, you have to have a very clear idea. Why do you want to fundraise? It can be because you want to test an idea and you don't have any money. That's a valid reason to fundraise. It can be because you want to grow. You already found something amazing. You're growing at 5% and you want to grow at 50%. Or it can be because you already topped the Mexican market and you want to go to the US or something like that. But you have to have a very clear idea. Why exactly is it that you want to fundraise? Because if you don't have that answer, you shouldn't fundraise. You should keep thinking about that answer. Once you have the answer 100%, then you go and fundraise, because you're going to have to give that answer to an investor, because they're going to ask you, why do you need the money? Why do you want to fundraise? You have to have a clear answer for them, and most importantly for yourself.
No, totally agree with you. Like, I've been thinking fundraising more for growth, so accelerated growth. But still, well, as you say, like if I still can do it with my own resources, maybe I can just keep doing that. But on the case that maybe later, I don't know, maybe next year, I'll probably need some fundraising. I mean, if that's the case, what tips can you give to us, like right now, in order to maybe start building the relationship with investors and these kind of things?
I think Yanira wanted to share the tips at the end, so we're gonna save the tips to the end, our general tips, and I think you're gonna find them useful.
Amazing. Thank you. Thanks both of you.
Great. Well, I see that new people join, so I don't know, probably you don't know the dynamic, but you can share your question on the chat or unmute yourself and ask directly your question to Alejandro or Pedro. I think someone sent a question here in this option that we have in Meet to send questions. And the question was, are there any platforms, web apps that allows you to contact VCs or angel investors that you could recommend?
I can share one that I've used in the past, which is called Angel List. I think it changed name. I don't know if it's still named that, but that's a platform. In my previous startup, we raised like $300,000 using that platform. Usually, you have to pitch to one lead guy there. They have followers, and they're gonna co-invest with that lead investor in whatever he says. So you pitch to that person, he's going to put a check of 10K, 15K, something very small, but he's going to pitch it to their followers. And a lot of their followers are gonna put small checks. They raised like a big, depending
A syndicate.
on what you're raising, a syndicate, that's a name. And then you get one single check of 300,000, 300K or 400 or whatever you're raising. I'd used that one in the past. I don't know, Alejandro, if you've heard of another one besides that.
So Crunchbase is a good one to identify both startups and VCs, and it can also give you a good ranking of how many, how much money they invest in, what industries they invest, how often, if they still have liquidity from their existing fund, etc. So I like Crunchbase to identify and do research, but then I agree, like platforms like AngelList, there's another one called Gust, another one called Seed Invest, and I think there's one but this one's Europe, I think it's called Seeders. But these are platforms that are used for, where it's not necessarily VCs, but they're more for syndicates, for angel investors, or folks that are just trying to get, that they're starting on their journey of investing.
Now that you mentioned, Alejandro, you mentioned Crunchbase. One specific way that I use Crunchbase is I research companies that were doing the same that I was doing in other geographies. I went through their list of investors in their early rounds, and I targeted directly those investors because they're likely gonna invest they already know the space, and they're gonna be very open to invest in a similar company if they did well in this other investment. So that's one way to use Crunchbase to look for investors.
That's a really good tip. Christian, you shared your question in the chat, but I don't know if you want to unmute yourself. And also, please, if you have any questions, this is like a good time probably to leave it in the chat. We still have some minutes for more questions. So this is a good time to share it. And probably if we don't have enough time to answer the question here, probably it's a good way to stay in touch with Pedro, Alejandro through LinkedIn, probably to still find the answer to your question. So, well, Christian, I don't know if you want to share that question and unmute yourself.
Yes, I already asked the question. So if there is anyone else that wants to ask anything before I ask this question,
okay,
they can do it.
Yeah, I think we have Braulio. Braulio, I don't know if you want to unmute yourself, or I can read your question. Okay, yes, I will read it. So Braulio was asking if do you know any institution that can evaluate a small emerging but not so young company. I think he's asking about the evaluation. Probably if you know any platform or company or someone that can help with evaluation.
In my experience, I've never seen a third-party institution give evaluation for a transaction. That doesn't happen. I mean, the evaluation is something that the entrepreneur agrees with the VC. So you say, I have a startup. I say I'm worth 50 million, but the fund says, you're not worth 50 million. You're worth 30. And if there's a transaction at the end, that's the real valuation of the company. The way when there is a transaction, I can say I'm valued whatever. The fund can say this company is valued whatever other number. But the real value of a company is when there is a transaction, when there is an investment done at that value. That is the transaction. So usually it's a negotiation between the entrepreneur and the fund. In the early stages, it's actually very easy. I mean, it's not so complicated. You don't even do it with a cash flow forecast. In pre-seed or seed, you just use kind of benchmarks. So any pre-seed company with the PowerPoint is worth between 3 to 5 million. There's a lot of articles out there from a lot of data from Crunchbase. So it's very easy to sustain that valuation. If it's in the US, it's a little bit higher. It's usually twice that. It's like between 7 to 10 million for a pre-seed or seed stage. And if you're worth 5 or 10 million, depends on how good are the founders. If you're a serial entrepreneur or you have very deep domain expertise, or if you are completely new and you have zero expertise in that field, probably your valuation is going to be lower. As you go along the path, I mean, you get out of seed stage and you go to Series A. There, the numbers start to matter more. Then you have to value your company based on unit economics, lifetime value, CAC, and these things. No? And probably by Series D, you end up valuing your company with a forecast cash flow, like any other company in any other industry. That's kind of the path. But I have never seen an institution used to make evaluation of a company, because if at the end one of the two parties don't agree on that valuation, there's no transaction there. So that's not the real value of the company.
Yeah, and I mean, just to add, I mean, a good resource for you to review, what the trends are, what the average valuations. Carta, they release quarterly reports and annual reports that are really good on those trends and what you should expect in terms of valuation, dilutions, etc. So I would sign up for that free newsletter. And just going back to the valuation, I mean, yes, it's very simple for the most part, very in a way back of the envelope for the very early stage. Of course, there's a negotiation, but then what does matter, when you have employees and they have they're going to be vesting shares, etc. There's something called the 409A valuation that will determine a value, of each share, and that matters, for the people that work in your organization as you vest. But that's just a quick added there.
That's a very important comment, Alejandro, because another question is, why are you using the valuation for? If you're using it to give stock to your people, then you have to use the 409. If you're using to get an investment from a fund, he can look at the 409 and can say, no, I don't agree with that. I'm not going to invest in this company based on that 409. So there's two different valuation concepts, but the 409 is required when you want to give stock, or you want to give stock to your employees, or some kind of vesting, or these things like that.
Super clear. Camila sent another question, and she's asking as an investor, how do you perceive it if the person delivering the pitch is not the CEO, but another member of the founding team?
From my perspective, I don't mind. For me, it's fine. I mean, if there are two co-founders, I mean, for the most part, I see two co-founders. I'll see sometimes three, but typically it's one or two founders. So if it's one of the co-founders, I don't mind at all. Like as long as they can, answer the questions. So from a visual perspective or narrative, that's fine.
Yeah, I agree. I would say that If it's not the CEO, if he's not one of the co-founders, then it's a huge red flag. If he's not one of the co-founders, but if he's not the CEO and he's not a co-founder, I mean, it's not usual, but it's fine. I mean, yeah.
Thank you.
Thanks, Camila. And here we have a new question. Also, please, we have still some more minutes. So if you want to share some questions, maybe 2 more, that will be okay. We still have some time. And okay, the next question is, which elements do you consider when choosing between VC funds versus angel investors? It's only funding volume?
I mean, I can start. I mean, when I think of, for me, they're just very different, right? I mean, when I think of, of angel of the investors, investor types, I would think about what is their motivation? For example, an angel investor will typically be someone that potentially that cares about you. Maybe you have a relationship with them. Maybe they care about the technology that you're building or the type of business. They want to get involved and share their expertise, right? But they're typically folks that will come early on, right? That's what they're angels. Like they're going to be people that share the passion for what you're doing, and it's more of like a one-time investment, right? So they help you early on so you can build initially, and then so you can then graduate, let's say, and then go and raise from other types of investors, whether it's VC funds or family offices. That I actually think we haven't touched on much here, but you should consider as an alternative. So, and angel investors are not necessarily folks that are going to be, they're doing it for themselves. They're putting a little bit of money. They probably have a very large portfolio of other assets. So you're just a very small portion, right? And so the motivation is different. And for VC funds, for them, they're out there because they need to return money to their investors, right? So they have a lot more diligence. The process of raising from VC funds is a lot longer than from angel investors. And they also have a target of ownership in mind, right? That doesn't typically happen with angel investors, right? So angel investor will be maybe a one-time thing, but with VC funds, you're going into a marriage for the next 10 years, right? So that's typically how I would approach it. I don't know if you want to go deeper.
Yeah, I think building on what you mentioned, Alejandro, I would summarize some things, some differences between VCs and angels. One is speed. Angels are very quick. They can write you a check even in an hour. VCs are going to take a month, 2 months. So speed is one difference. The other one is ticket size, which you also mentioned. Angels are going to write very small tickets. Funds are going to write much larger tickets, $500,000, $2 million, $5 million. And angels are going to write like a 25K, 50K, maybe 100, probably no more. And the other one, which you also mentioned, Alejandro, is the follow-on capacity. Usually the angel has no follow-on capacity, while VCs, they even allocate some part for follow-ons. So if you need more money, which is very likely in further rounds, VCs can give you that money and angels can't. So just to summarize those 3 differences from these funding sources.
Great, thank you. I think we have our final question. Javier Quinte shared, do you recommend setting a minimum investment amount such as $5K USD, or is fine to accept tickets of any size? Probably he's talking about the angel investor, but I don't know if you have any comments on that.
I would say definitely you have to have a minimum. I would put it much higher than 5K. I mean, it's very time consuming to deal with an investor. Just to accept the check and to give him updates every month and to answer their calls, probably for 5K it's not worth at all. I mean, yeah, definitely you have to put a minimum. And you can make an exception. For example, The smallest check I ever got in my previous startup, Megabyte, was from Travis Kalanick, the previous founder of Uber, the CEO of Uber. Of course, I'm going to make an exception if he wants to put, I don't know, whatever, $500, I mean, whatever. I want to have him on my cap table. But as a general rule, yes, you don't take small checks and you put a minimum. That would be my advice.
Yeah, and maybe just to add quickly, there is, I mean, if you're trying to bring maybe initially like some friends and family, that's okay. But ideally, yeah, you don't want to be, you don't want to be dealing with so many investors. Try to keep your cap table as clean as possible. Like the fewer investors, the better, and make those choices strategically. I mean, if these are people that are going to be part of your business for the next 10 years, be careful and mindful of who you want, to have that relationship with.
Also, we just have a few more minutes, but before closing, I would love to hear Pedro, Alejandro, if you want to share some specific tips or some final recommendations for the audience. I think that will be really helpful.
Great. Do you want to start, Alejandro?
I mean, sure thing. So I think, tips that I would think about is, and I think in a way that's how I started, but I would think about, is this the right time to be raising? Like, do I need to raise, first of all? And if I do need to raise, how much money do I need for at least the next 2 years, right? To survive and to be able to one, prove out what I want to, and have a little extra. But whenever you're out there raising, think about your fundraise as buying time and building, relationships, right? So it's easier to build in many ways when you have your team and you're self-focused. So when you're ready to raise, just understand, and many of you are already living this, but it takes time. Sadly, it takes much longer now than it did a couple of years ago. And so you're going to have 2 full-time jobs, which are building the company and then fundraising, right? So be able, understand that, to have a team to support you if possible, or a co-founder that can support you with the other side of the business while you're fundraising.
Yeah. So my general advice in the process of fundraising would be, first of all, when you go to pitch, go with energy. Energy shows when you pitch to an investor, and that's very important. Secondly, you're going to raise with emotions, not with the head. So investors are going to invest in your story, not in your numbers. Okay, so you have to have a good storytelling, a good framework to how you see the future to fundraise. You're not going to raise with your Excel spreadsheet. That's not what makes investors tick. Although most people think that is, but that's not the case. Third, volume. We mentioned this before. Volume is the name of the game. You're going to have to pitch a lot of times because you're going to close 10, 15, if you're a rock star, 20% of whatever leads you have to fundraise. So if you want to close 10 investors, you're going to have to pitch to at least 50 different investors. So be prepared to do that in the shortest period of time possible. Fourth, adjust your deck and your pitch after every interaction. So in every pitch you deliver, you have an opportunity to see if the investor clicked at some point, if they understood your ideas, if they get excited as you thought they would or not. And you adjust for the next time. Adjust. So by the time you make your 15th pitch, you're much better than your first one. That should be the goal. And lastly, be prepared on the terms of the round. This is very important for entrepreneurs because usually funds do this all the time, and you raise one seed round, but they invest in, I don't know, 10, 15 companies, and they see 100 to 1,000 a year. So they know every single term they have to negotiate, but you don't. And if you don't know what terms you're signing in your term sheet, it can end up really bad. So read a little bit, read some articles, read a couple of books before racing around, and be prepared to negotiate the terms. Choose which terms are important and which terms are you willing to let go. And that's it. I will focus on those 5.